This video is called It's Over. Trump purposefully crashing the stock market.
Nobody ever gets rich when the interest rates are high because people can't borrow money.
Is that what you meant? The stock market going down was the disruption? What other disruption were you alluding to?
Look, you can't really watch the stock market. You have to do what's right.
What's up, you guys? It's Graham here. So I don't usually do this, but 2 weeks ago, I issued a warning to stock market investors. And unfortunately, since that video, things have gotten a lot worse. Just today, the market has seen its worst drop since 2022. Panic usually creates more panic, selling pressure creates more selling pressure, and prices are falling purely because...
Okay, that's trend following. Now, I thought Graham was going to be more of a buy the dip kind of guy, so I'm curious to see where he goes from here. I already like the video, but to his point, let's go back just a moment, and I'll show you a cartoon from like the 1950s in the Wall Street Journal that says exactly what he's saying.
Things have gotten a lot worse. Just today, the market has seen its worst drop since 2022. Panic usually creates more panic, selling pressure creates more selling pressure, and prices are falling.
Right, selling pressure causes more selling pressure. This is how the market works. When more and more people start to sell, selling begets selling, buying begets buying. This is what a trend looks like. The selling right here is where we are in stage 4 in so many stocks. Everybody is screaming sell. So if you're the one guy who's saying, now's the time to buy, you're about to get run over. So let's continue to see what he says here.
Purely because prices are falling. So similar to my previous video, I'd like to help put into perspective exactly what's happening, why the market is crashing, how things could get worse before they get better, and what you could do about it to put yourself ahead financially. Yes, I'm probably going to have to repeat myself a few times, but at least you should understand the truth about what's actually going on. As soon as you hit the like button and subscribe if you haven't done that already, that's all I ask for. It helps the channel tremendously, and as a thank you for doing that, I will do my best to read and reply to as many comments as I can. So thanks so much, and also big thank you to Incogni for sponsoring this video, but more on that later. All right, now in terms of why the market's crashing, as of now, we have the perfect storm, starting with tariffs. Now, here's the thing when it comes to talking about tariffs. So far, here's how they've worked. Trump threatens tariffs by a certain date. The market goes down, but eventually starts to recover. On the day tariffs go into effect, the market plunges because no one expected it to actually go through. But 24 to 48 hours later, an agreement is reached that gives an extension. The market goes back up. And then the process repeats itself when tariffs go back into effect, waiting for another agreement to be reached. This volatility starts to give the impression that tariffs have simply been used as a negotiation tool to get more favorable trade deals within the United States, but the market never actually priced in the likelihood of them sticking around. Until this, it's currently scheduled that a 25% tariff on steel and aluminum imports are set to take effect March 12th, while a 250% tariff on Canadian dairy products could be next, along with a tremendously high tariff on Canadian lumber shortly afterwards. On top of that, what's really fueling the tariffs is that he said tariffs may still go up as time goes by. Now, even though that 250% dairy tariff has largely been debunked as an item that's not even going to begin going into effect, since they will be allowed a certain amount of dairy to enter the United States tariff-free, business owners are completely puzzled by what to expect if they need to order inventory ahead of time, or if they have to start raising prices to cover overhead, to which Trump provided no additional information. To make matters worse, Canada retaliated by enacting 25% tariffs on electricity imports to New York, Minnesota, and Michigan starting right now, and China slapped back with 15% tariffs on American farm products. As a result of this, investors are beginning to price in the likelihood of higher prices, lower GDP, recessionary fears, and the potential that things could soon get much, much worse. But there's a second reason the market could be falling that most people have no idea about, and that would be Trump crashing the market on purpose. First of all, it's important to clarify that this is just a theory. But you know what? Nothing surprises me anymore. So here's what we know to be fact. Right now, it's no surprise.
Now, this would surprise me, Trump crashing the market on purpose, because Trump, being as boisterous as he is, politics aside, we all can objectively look at Trump and we can say he wants to be known as a huge president. He wants to be known as a tremendous president, right? We know this. And part of a president's legacy is how the stock market did during that time. So I'm very surprised that he specifically would be wanting the market to go down. That's a hard concept for me, looking at Trump and his bravado, Trump and his boisterousness, because he can't point at a scoreboard so much. I mean, he can point at illegal border crossings and things like that, other parts of his plan. But when he can't point at a scoreboard like the stock market, I'm really surprised. So I don't know. And to Trump, you know, he likes to do the bargaining, right? He's the art of the deal guy. But I don't know about this whole he's specifically trying to crash the market. I don't know. It just doesn't make sense to me.
Surprise, the government owes a lot of money. The national debt is currently sitting at over $36 trillion, and that number is only expected to keep going higher, which is soon going to cause a lot of problems. Why? Well, when you have a debt this large, you have to pay interest on the debt, and when interest rates are at record lows, paying off the debt is very easy. Like, imagine it to be like a mortgage. Taking out $1 million loan at 0.5% interest is as simple as spending $5,000 a year to keep current on your monthly payments. But what happens when interest rates go up during a time that you're borrowing a lot more money and you've only locked in that record low interest rate for a few years? Exactly. Since interest rates have gone up significantly, the United States is now spending more money on interest payments than they are on defense for the first time ever in history, which is massive. And in 2025, there's another $9.2 trillion worth of debt that needs to be refinanced. This means they either need to lock in rates when everything is high, or they need to create a market crash, which causes interest rates to fall and gives them enough time to lock in interest rates for the next few years. Again, even though a lot of this is just a theory, some of it does make a lot of sense, because 70% of the $9.2 trillion debt needs to be refinanced by June 2025. And if nothing is done, that debt is scheduled to cost 1% more, which is reported to be $1.56 worth of cost for every $1 of revenue that the United States generates. Think about it. For Trump, this could be a huge win to refinance the national debt at a lower interest rate than usual by forcing the Federal Reserve to lower interest rates. Like, here's some quotes that I pulled from Anthony Pompliano, who's taken the time to compile some choice words by Donald Trump. Here you go.
I've been saying, let's get interest rates down. Nobody ever gets rich when the interest rates are high because people can't borrow money. Interest rates are going down. You know what else is going down? Energy's going down. I'd love to see energy go down.
Is that what you meant? The stock market going down was the disruption? What other disruption were you alluding to?
Look, what I have to do is build a strong country. You can't really watch the stock market. If you look at China, they have a 100-year perspective. We have a quarter. We go by quarters.
That's true.
You can't go by that. You have to do what's right.
All of this paints the picture that maybe this is his way of reducing the cost of the national debt. Perhaps he could frame it as such a way that he's making asset prices like stocks, real estate, and Bitcoin more affordable to middle-class Americans by giving them a 10 to 30% discount. And if short-term pain is what's needed, then he's willing to get there by any means necessary. Although in terms of how bad things could potentially get, you're going to want to take a seat. Although before we go into that, just like it's really important to protect your investments, most people have...
We will be skipping this ad, by the way.
Absolutely horrible. The good news is that you have a right to protect your privacy and request you removal request. Step 100% off an phone. All right, now in terms of how bad things could potentially get, you're going to want to hear this. On a broad scale, there are 3 different types of declines that you're going to want to be made aware of. The first is what's known as a stock market correction that's defined as a drop of at least 10%. Now, it's important to recognize that normal volatility throughout the market is extremely common. Like, since 1920, the S&P 500 has, on average, seen a 5% pullback 3 times a year. So random fluctuations happen all the time. This is also somewhat the case with market.
And while that is 100% true, corrections happen all the time. The last 2 years, 2023 and 2024, the market was up greater than 20% in both of those years. Because the market was up greater than 20% in both of those years, people got really complacent that the market only goes up. When the market only goes up, buy every dip. And I think that's where a lot of YouTubers right now are about to hit the wall. They're about to have the shit hit the fan because they forgot what risk is about. Remember, I want you to take this to the grave. All stocks are bad. Now you're probably thinking, what is he talking about? All stocks are all 100% of all stocks are bad. They are all bad. What do I mean by that? Every single stock is risk. If you own a stock, you have risk. That's what I mean. All stocks are bad because they have risk. Every once in a while, they act right. And when they act right, that means that you can take advantage of when it's in a stage 2 uptrend. And it doesn't happen all the time. Every once in a while, it acts right. But every single stock is risk. And I really feel like a lot of people have absolutely thrown risk out the window. Like, the market can't go down. The market can't go down. And yet, they're getting absolutely destroyed.
Corrections, which have happened on average every 16 months. In fact, if you're like me and you like averages, so far the average stock market correction has been 15.6% and lasts for 71.6 days. So it's perfectly normal, and every healthy market sees a regular pullback from time to time. However, after that, we move on to the more serious category, and that would be a bear market, which is defined of at least a 20% drop from the peak. And this is where the NASDAQ might soon be approaching. According to the data, this typically hits every 7 to 10 years, and when it hits, unfortunately, it hits kind of hard. During a bear market, the stock market drops on average 33% 3.2%, and it falls over a period of 363 days. Now, it is important to clarify that these are just averages, and it doesn't mean the next bear market's going to fall exactly 33% and last for exactly a year. For example, in 2020, we saw the fastest 30% drop in history since the Great Depression, and then right after that, we saw the quickest recession in history, which lasted just 33 days. So anything can happen. Although in terms of taking it even further from here, things can always get a lot worse, and that's what brings us to a stock market collapse. I would consider this to be a drop of at least 40% throughout the entire market, and not just in one sector like cryptocurrency. And over the last 120 years, this has only ever happened 3 times. This is why a market collapse is rather uncommon, but it's not impossible to happen throughout our lifetimes, which is something that everyone needs to keep in mind. But in terms
And it is something everyone needs to keep in mind. Totally is. Because any one of these could happen at any time. And if you are listening to some YouTubers, any one of these, with that line, I don't know where that was supposed to be. It starts like this, okay? This is the start. This is not the end. And that's where I get really frustrated, is when the market is moving down like this, that is not the time to be buying. In fact, we did this exercise yesterday, but let's do it again. Let's look at COVID on the left and today on the right. And I know, because I've seen your comments, oh, it's not the same as COVID. Trump didn't cause COVID. Shut up. All right, just shut up. What is happening is price. That's what matters. When I see this on the right-hand side, this is today. This is COVID, right? COVID went way down. It went down 35% in 22 days. During that 35% in 22 days, there was a lot of panic in the market. We did not know that it was going to bounce right back up. So what I wanted to point out here is that you can use the outlier trend template, the 10 over the 20, price over the 50, and you can see when it stops going down. Let's make this even bigger for you. All right. This is where we are today, where everybody's screaming buy the dip. Can it go back up? Absolutely, it can. Is it going back up right now? No. Because it's not going back up right now. Now is not the time to be buying the dip. If you wait until the outlier trend template turns over right here, you could have seen a 10% gain on your investment before these people got back to break even. So buying the dip does work, 100%. But on the right-hand side of the dip and not on the left-hand side of the dip. Now, until I get the Nancy Pelosi upgrade on my charting platform, I won't be able to see when that dip stops. But you can mark on your calendars. When the 10 crosses over the 20 and price crosses over the 50, the dip has stopped. That doesn't mean it will stop forever, but the dip has stopped and prices are moving back up. We're now in a bullish trend. So watch for that.
In terms of what you could do to use this as an opportunity to come out ahead profitable, here's my take on things. First, when it comes to building wealth, it's important to recognize that there's always going to be a reason not to invest. Like when I started buying real estate in 2011.
I agree with that. There's always a reason not to invest. Absolutely. And that's why when you put on a stock, give it room. And one of my mentors, Tom Basso, one of the market wizards, if you want to go see my interview with Tom Basso, it's on my YouTube channel. Just go over to the playlist and hit the market wizards playlist there. Tom Basso says you can buy any stock on any day at any time. It really doesn't matter. In fact, the conversation I had with him was, I just bought this stock. I'd never even heard of it before. And he's like, I do that all the time. And he was so flippant about it. And I'm like, what do you mean you can do it all the time? And he's like, doesn't matter to me. A, if the price is going up, that's all I'm looking for. And B, if you know how much risk you're willing to take to find out if it's going to work, that's all you need to know. So if it's a $100 stock and you give it $1 to find out if it's going to work, if it doesn't work and it takes that $1 out, that's okay, no big deal. But if it's a $100 stock and it just goes up from your entry point, you can ride that as long as it goes up. So there's never a right time. There's always an appropriate amount of risk that you have decided you're willing to take. That's the right time. How much risk are you willing to take equals the right time.
The overall market had already fallen 50%, and I was buying some of these properties for 20 cents on the dollar. But I was told to wait because shadow inventory was about to be unleashed on the market and prices were about to fall even further. But guess what? That shadow inventory never came, the market recovered, and I'm so glad I didn't listen to all the people who told me not to buy. Even in early 2017, when I started making videos here on YouTube, there were so many headlines about how the market could be poised for a crash or how the market was overvalued. But I just kept dollar cost averaging on a regular basis, and I'm glad I did. The same thing applies to 2020, 2022, and I'm sure even today.
Okay, I adamantly disagree with dollar cost averaging on the way down. If you want a dollar cost average into something, do it on the way up. So let's give an example here real quick. Let's say that you're dollar cost averaging and your retirement account into an asset that looks like this, and you dollar cost average all the way down, and you get to retirement over here on this side, and you are down money. You actually have less money in your account than you did 20 years ago. And you're like, but I did everything right. The problem is that the asset you were in was going down. And even though you dollar cost averaged into it all the way down, until it starts going back up, you're still losing money all the way down. And that's because only price pays. You can dollar cost average into anything at any time, but you're not going to get paid until it starts going back up. And the problem is that people think it always goes back up. It always goes back up. And we are very conditioned on the market to say it always goes back up. But let's also do another exercise. Let's look at the NASDAQ in 1999. Probably know where I'm going here. We'll do this on monthly candles. The NASDAQ in 1999 peaked. March of 2000 is that candle it's on right there. When did it make it back to that point? You could have dollar cost averaged all the way down, or you could have dollar cost averaged all the way up. It took 17 years. 17 years for this to come back. Are you really okay with waiting 17 years to be back to break even? I'm not. Nope. No, sir. And that's why I say keep risk first. Always trade risk first.
Second, investing is not a game. I hate to say it, but when you really get down to it, investing shouldn't be fun. It should be pretty boring. I know that sounds
I actually agree with that wholeheartedly. Wholeheartedly. Investing should be boring.
weird to say because for me, investing is a total blast and I love it. But it's not a sign of a healthy market where people are trying to YOLO their life savings into whatever is the hottest stock of the day to try to get a brand new Cybertruck. At a certain point, you have to remember, if you're trying to beat the market average, you're either taking a calculated risk or you're gambling. And the line between the two has gotten incredibly blurred over these last few years. Third, overconfidence is going to destroy your portfolio. The moment that you think you have the entire market all figured out, you've lost. Because of that, it's really important to recognize that the less you know, the better you will do, because you're not going to overcomplicate things and take unnecessary.
I wouldn't say the less you know. I say the less you assign an outcome. Assign a, hang on, what's the word I'm trying to think of? I have it on here. The less that you say that you have an expectation, that's what I'm thinking of. The less expectations you have in your trade, the better you'll be. You're probably thinking, what do you mean less expectations, the better you'll be? I expect to win. I expect to win, Chris. Okay, well, what happens if it doesn't work? Are you going to expect to hold that until it does? Like in our Q's example just a minute ago, are you going to hold it for 17 years until it does? Are you going to be that stubborn? No. If you have no expectations in the trade, you just have a series of exit signals and you'll get out when one of those are hit. That is how you make investing work. Trading, investing, doesn't matter. To me, they are the same. Longer term, shorter term, it doesn't matter. If you have an exit signal, number 3 right here, you sit and you wait as long as it takes. And if you're a long-term investor, maybe that's a year and a half. If you're a short-term trader, maybe that's an hour. But if you have your exit signal in place, which is what I ask you all the time, what's your exit plan? That's what you need to know.
Necessary risk for gains you never needed in the first place. For example, every single study shows that the best investors of all time simply buy into an index fund on a regular basis and hold it for 20 years.
Okay. But imagine they held it for 20 years and they got into it right here. Would you call them the best investor of all time if he happened to buy it right at the top? And then he goes 17 years with no gains and then he's only up, 2% 20 years later? No. I think finding these outliers, ironic to say that, but finding these outlier buy and holds, I think it's disingenuous.
This is why dead people often make the best investors, because they don't touch it. They just buy and they hold. And that is,
I mean, you can buy and hold anything. You could buy and hold AMD as it's going down. Right. You can buy and hold. Let's do an index fund. Let's do. Give me any index fund. Go. I can't think of anything off the top of my head. But if I go into Outlier, this is cool. You'll like this. And then I click this button right here. It'll give me a list of all the different indices. I'm sorry, not indices, but the different sectors. So let's go to XLB. That's the material sector. XLB. I mean, you could buy and hold XLB in 2024. Let me remove all my notes here. You could buy and hold XLB right here, and then it goes sideways, and you're up a little bit, and now you're down a little bit. Like there's no guarantee on any. Like I picked this one at random. This is a great example. I picked this one at random, and I have to go to the weekly chart here, and it's basically gone sideways since 2021. It's gone up a little, it's gone down a little, it's gone up a little, it's gone down a little. So a dead investor would be doing great, I guess, in the last 3 years because it's gone up a little and down a little, right? Right? No, I disagree. Looking at the indexes, which have historically gone up over time, I am not discounting that. I am not discounting that. But for something like this peak at the end of 2021, took you until January of 2024. That's 3 years. 3 years that you weren't making money. Unless you were into stocks that were moving up.
Is what chances are you probably need to do as well. Fourth, let's face it, a market drop is probably going to be a lot worse than you expect. Like, you know when you see a decline, so you buy in, and then it drops even further, so you buy in even more, and then it keeps falling until eventually you run out of money and it keeps falling even more? Well, generally, market bottom takes place at absolute investor capitulation, where people think the economy is...
No way. The bottoms take place where? At capitulation? You mean literally the word capitulation? That's the bottom? How ironic. It's funny because that's like how this works over time. This is not a one-time thing. This is how the market works. It's so funny he said specifically that word right there.
Forever finished, no one is buying in, and people think to themselves that it'll just continue getting even worse. This was the case back in the worst of 2020, 2010, and I'm sure back in 2001, even though I was too young to remember that one. Every generation, I promise, is going to have their own moment when they think to themselves that this time is different, and even though it's always recovered in the past, this time, today, has never been like anything before, and we're probably all finished. That's why I tend to think that it's reasonable to expect that things can always get a lot worse than you expect them to, and just to be prepared for that. Fifth,
and if you're prepared for it, you're trading risk first.
good financial habits should be practiced in both good and bad markets. Even though now is certainly a great time to work some extra hours, take on a side hustle, cut back on unnecessary spending, and invest the difference, ideally, you should be doing that regardless of where the stock market trades. Yes, I understand it's not cool to live frugally and live below your means when everyone else is making 10x returns on meme coins, but I promise you, if you just stick with it long term, it's going to pay off 10 times more in the future. I guess I've just seen so many careers come and go, so many businesses go bankrupt out of nowhere, and so many investments lose value that I just tend to be overly cautious about what I do. Plus 6, it was found that in the event we hit a bear market, that half of the S&P 500's strongest days in the last 20 years occurred during a bear market, and another 34% of the market's...
I would really like to point this out because this is one of those logical fallacies that people really mess up on, because they say the strongest days in the last 20 years occurred during a bear market. Let me give you some perspective on what that looks like. So if we go to the SPY and we go to COVID, I'm going to show you exactly what this means. And you're not going to believe it, right? The biggest up moves happen during bear markets. Now, let me show you a perfect example of that, right? Imagine just for a moment that you buy the low right here and you sell the high. The market was up 9% in a single day. In one day, the market was up 9%. That's pretty incredible. But we all know you aren't buying it on the low and selling it on the high. You don't know that the price is going to end up 9% the day before. And lastly, and this is where the logical fallacy comes into place here, you're buying it still within this downtrend. It's still within this downtrend. So even though it was up 9% that day, until it hit the low, it was 20% lower from this candle. And where did that candle break even? About right there. Because of this like V bottom It was 17 days later. But that one candle on its own did nothing. That one giant move did nothing. The 10 best days in the market, if you're not invested in the 10 best days in the market, you're missing out on all these gains. I'm pretty sure that was the best day of the market. And it still went down 20% after that point. So anytime you hear somebody saying you can't miss out on the 10 best days of the market, they're coming in downtrends a lot of the time. And then that downtrend is not over on that one candle. So let's do a couple of these examples, right? So this was 9% right here. This was 6%. This one's in my way. This was 5%. So because you are the smartest investor of all time, you got this 5% gain and you sold out. You got this 9% gain and you sold out. And you got this 6% gain and you sold out. You are a genius. And so these are probably 3 of the top 10 days in that year. And they all occurred in the midst of this huge downtrend. So somebody telling you, if you miss out on the 10 best days of the year, you miss out on all the gains. You really think that those are the right times to be buying? No. We know that. We know that. But I appreciate him. I appreciate him very much mentioning that. By the way, I didn't get a chance to introduce myself real quick. My name is Christopher Ewell. I've twice been awarded top 100 people in finance. I was mentored by 5 of the market wizards, the best traders of all time. I've been successfully trading since 2009, and this is where outliers like us save time, make money, and start winning with less risk together as a team. Now, I want you to subscribe if you haven't already, and let's drop your video ranking in the chat. Here's the deal. I actually think this was quite a good video. I liked a lot of what he talked about here. Let's cross off number 6. But the rest of it, I actually thought was quite good. So how would you rank it? How would you rank it? I want to hear in the chat. And here's our scale right here. How would you rank it? An Ask You made it. How you doing? How would you rank this one? And real quick, while that's loading up, I want to go over to my YouTube channel and see if our team posted this poll. There we go. Okay, good. I wasn't sure if they did. All right, let's see. We've got some 8s, some 6, some 7, some 6. Oh, wait. Wait a minute. Y'all, you almost got through with that, Canwall. You almost got through with that. But here's the deal. Nobody gets a 7. Nobody gets a 7. Because no one gets a 7, it makes you get a little bit more thoughtful in your response. That's why nobody gets a 7. So we got a 5, we got a 6, nope, we don't get a 7.5. We got an 8. A 7.0001. It's not a 7. If you're so good, why don't you trade for Warren Buffett? I don't know, man. If you're so good, why don't you get bounced out of here? Oh, no, I won't bounce you. I thought about it, though. Leader Motorcycle / Mikey Mike says between 6 and 8. Dale says it's 8 minus 1. Let's see. Nico says 5. Daniel says 6. I'm so mad I lost $6 in sell off. Risk first. And absolutely right. And here's the thing, Chris. Turn off your P&L. I know this sounds crazy. Turn off your P&L and focus on your plan. Focus on your plan. If you have a plan with a statistical edge in the market, your plan should print at the end of the year. But each individual trade, it's a random outcome if it's going to be a win or a loss. So I think that was actually quite a good video. So let me grab a screen cap of this real quick. And here, this is our first video from Graham Stephan on this channel here. And I'll tell you, it was better than I expected. Better than I expected. I'll put it in an 8. An 8 is a high bar for me. I'll put it in an 8. So thank you all for participating in that. Now, I want you to remember that this is super important. If you don't remember anything, take this to the grave. You can save 64% on the annual pass. That's just 82 cents a day over outlier.com. And if you are in the free trial, you can shoot us an email over at support@outlier.com that you want to upgrade, and we'll take it from there. But let me ask you a question. What do you think? Question is, risk management is the most important thing for trading. if you don't respect risk, they'll eventually carry you out. What do you think? Go on my YouTube channel and vote on this real quick, because we will absolutely be looking at your results in a minute. But ignore risk, chase wealth. That's kind of what Graham Stephan was talking about in this video, where people are YOLOing their life savings into different things. And a lot of people are making a lot of returns. That's a real thing right now. A lot of people are. Maybe they're buying puts on Tesla, which was down 15% yesterday. Maybe they're buying puts on AMD, which looks like it's never going to go back up. Or respect risk and stay alive. I can see both of these. But I want you to go vote on my YouTube channel, and we'll cover that in not into a minute. And we'll cover that in just a minute. So put your stocks in the chat and let's take a look at what you guys are looking at today. I'd really like to know. Take this to the grave with a bait and switch. Thank you. I was trying on that one. Thank you. Michael Plummer saying respect right there. And Michael Plummer, I respect you, my friend. You know what's going on. So let's take a look at some of these. GLD. Let's go, Brandon. Let's look at GLD. I know a lot of people are looking into gold lately, saying that this could be a good place to go while the market is going down. So I like that. I like the thought here. Let's take a look at it. GLD. Got a sell signal right up here near the top on GLD. On February 24th, we got a sell signal in Outlier. Let me make this bigger for you. And one thing to keep in mind is this behavioral heat map right here. As you can see, it's gotten really greedy. So it got a greed value of 39 out of 50. And so I like to look at it like a rubber band. The further it gets stretched into the greed, or further it gets stretched into the fear, the faster it can snap back. And for gold, it definitely had that snapback right after that sell signal. Very interesting there. People are getting a little less greedy on gold. And for the gold sector, I guess you could say, it's certainly getting more fearful. So good one on that one. I appreciate that. Let's go to the next one here. Knight wants to look at Beam. BEAM. Taking a look at Beam right here. We do have a buy signal. All right, let's take a look a little closer here. You have a buy signal today. Looks like it might have run up. It might have peaked, and this may be a bottom. Let's see on Beam real quick on the moving averages. Beam. I have to zoom back over. Oh, that was today. We don't quite have the moving average cross just yet. So it's still looking like a potential short setup to me. Your price is 10 under 20, price under 50. It does have quite a lot of bullish order blocks down here, but also has quite a lot of bearish order blocks. So if we look at the heat map value of this in particular, we got a buy signal just yesterday at G10, still at G10 today, while the healthcare sector is getting a more fearful. This one's getting slightly more greedy. It's between these two order blocks right here. Beam looks like it's going to bounce around in this area for a hot minute, until it can get some real strength one direction or another. I think it's going to really struggle to get through here. So good one there. I liked it. Let's go back over here. Let's see how you guys voted here on this poll. I want to see how y'all voted. All right. So for me, risk management is the most important thing in trading. If you don't respect risk, eventually they'll carry you out. I say respect risk, stay alive is so much more important than ignore risk and chase wealth. Can this happen? Yes. But the amount of risk that you're willing to take to find out is crazy. We've all heard of these Wall Street bets people who get into a couple really great trades. They think they are masters of the market, and then they're gone a few days later, right? Their entire account's gone. You don't need to do that. I want you to stay in here for the long run. So I would say respect risk and stay alive. And 96% of you also feel that way. That's pretty cool. So we saw how you voted. So of course, be sure to tell me in the chat what you're trading and come back tomorrow where outliers like us will save time, make money, and start winning with less risk together as a team. Now, YouTube is going to recommend a couple of videos. I recommend you click on one of them. And I also recommend you come to this afternoon's live stream. We'll talk soon. See you there.